This is the final video in a three-part series covering various financial disclosure issues. In parts 1 and 2, we covered related party transactions, subsequent events, and reporting for diversified companies. In this part, we will cover management's discussion and analysis, forecasts and projections, and briefly introduce financial statement analysis. Management's discussion and analysis is included in the 10K and 10Q, but unlike the financial statements and footnotes, it is unaudited. Auditors have a responsibility to review this information and verify that it is not inconsistent with the financial statements, but this threshold is much lower than that of an audit. The MD&A is where management can make additional disclosures related to liquidity, capital resources, and the results of operations. Management must also disclose its responsibility for the financial statements and the controls over financial reporting. This is a classic CPA exam question. Who is responsible for the financial statements? Ugh. Thanks for clearing that up, Chloe. And for the record, no, neither of them ever listens, but they're still good dogs. The next topic we're going to discuss is forecasts and projections. Financial forecasts are a set of future financial statements given expected conditions. Essentially, these are management's best guess at the future. Because no one can predict the future, there is a safe harbor rule that protects companies so long as their forecasts were prepared with reasonable care. If not for the safe harbor rule, no company would ever issue forecasts for fear of legal action, which would be unfortunate given management is in the best position to predict future performance. Financial projection, on the other hand, are a set of future financial statements given hypothetical conditions. These financial statements are often used to evaluate the potential profitability of a major investment or the outcome of a merger. The disclosure of financial forecasts, the ones that provide expected outcomes, has its pros and cons. When an investor evaluates financial statements, they are looking at historical information in an attempt to predict the future. If management provides their expectation of the future, that would undoubtedly be valuable information to investors trying to make their own predictions. Also, many argue that the business climate now changes so fast that historical information is insufficient for high-quality decision-making. However, because no one can predict the future, forecasts are guaranteed to be wrong 100% of the time. Financial forecasts are currently voluntary disclosure, and some argue that requiring forecasts would improve their quality due to enhanced regulatory oversight. However, the downside here is that once these forecasts are out in the world, management has incentive to manage earnings to meet those forecasts because, as our third con notes, inaccurate forecasts are bound to be penalized in the market through stock price decreases. Finally, as we noted when we discussed segment reporting, management does not like the idea of forecasts as a required disclosure because it is too much information to provide to competitors. Suppose a company was planning a merger in the next reporting period. If the company builds that sudden growth into their forecast, they telegraph the move and possibly sour the deal since merger negotiations are often highly secretive. But if they omit the merger from their forecast, they run the risk of legal action for knowingly omitting a material transaction from their forecast. Finally, I will introduce the concept of financial statement analysis, which we will look into further in future lecture videos. In this course, we will do only a very basic overview of financial statement analysis. This will be most helpful to those of you who are not taking Finance 3461, and it's a good primer for those of you who are going on to our MSA here at UCF, where we have an entire course dedicated to the subject. In financial statement analysis, we think about financial statements as a means of answering a question about a company. So for example, an investor will look at the financial statements and want to know, would this company be a profitable investment? Or, if they already own stock, should I continue to invest in this company, or is it time to sell my shares? Creditors look at the financial statements with a different intent. If we loan this company money, will we get it back? Or, will this company be able to pay interest according to the terms of this loan? Once we have identified what we want to learn from the financial statements, we need to identify which information will answer our questions. Some typical tools used are financial ratios, trends within the company over time, and comparisons to competitors. There are some caveats we will need to consider when we start financial statement analysis. Financial statements always report what happened in the past, but most financial statement analysis questions are attempts to predict the future. We also need to make sure we keep in mind the big picture. When performing ratio analysis, does just one ratio give us concern, or are there multiple ratios confirming the same trend? If we do identify a bad ratio or trend, what is the underlying root cause? Is the cause transient, or will it persist? And finally, what are the macroeconomic factors at play? Is the entire industry in a downturn, or is it just the company we're analyzing? This concludes part 3 of our series on disclosure issues. Be sure to email any questions for our discussion.